Welcome to Classic Value Investors and Microcap Explosions. This is Mariusz Konieczny. What I am holding here is a dividend check, okay? And it is a dividend check from Darden Restaurants. I own one share of Darden Restaurants that I bought through a DRIP program, direct reinvestment something. So I own one share of Darden, and it is not in my brokerage account, and I get dividends, okay? And today, and I'm going somewhere with it, so hang on. Today, I'm going to open it, and I'm going to see what kind of a check I received, okay? So I received a check for 88 cents. And now I have absolutely no idea what the Darden stock is trading for. I've owned the stock since probably 2006 or 2007, and I have no idea what the stock is. I have no idea. All I know is that I get dividends every quarter or so. I get a check like this in the mail, and I deposit it in my bank. Now, why am I saying this? Because in today's world, we are so obsessed with stock prices that we forget about what ownership in businesses is all about. If you're an owner of a business, you either own it for the cash flow that it generates, or you own it because the management will increase the value of the business in the future, and you will be able to sell your shares at a higher price in the future because the value of the business or asset or whatever will increase. So in this case, you don't own it for the dividend, and that's how I usually do it. I don't usually own stocks for dividends. You own it for the underlying value behind the ticker symbol. When it comes to, receiving dividend checks, whether they are deposited in your account or whether you get your dividend check sent in the mail, like in the case of this particular one, and it's only one that I own like this, one Darden Restaurants share, and I don't own any other stocks like this, because at that point I was playing around with DRIP, and so somehow I bought one share, and I own it in my name. It's not in the street name, meaning it's not in the brokerage account. My name is directly on file with the company, and then they send me the checks directly. But I think that this is the ultimate way of owning businesses, right? And I remember when I was into real estate years ago, it was, in the 2000s, and I went to this seminar, and the people at the seminar were saying how real estate is superior to the stock market because, look, you can put so much into a house or a condo, and it throws out this much in rent, and your return on investments or cash on cash return is this much, and and it's so stable, and you couldn't get it in the stock market. And it's just an absolute nonsense, because you're comparing apples to oranges. You see, with real estate, they focus on the return that the actual business generates from rent and what you paid for it. But no one is quoting you what you can sell the house or a condo or your investment or apartment or whatever. No one is quoting you every 5 minutes what that thing is worth. So you are actually focusing on the cash flow. You are actually focusing on the fundamentals, where in stocks, because the price is quoted every second, every minute, every day, people don't focus on the fundamentals, they focus on the price action. And that's why they're using technicals and charts and all that to focus on the price movement instead of the fundamentals. If they focused on the fundamentals, then yes, they would focus on the dividend checks, they would focus on the what the dividend is in relation to the stock price, and then they would calculate the dividend yield. They would focus on net income versus book value or net income versus what they paid for the stock, and that's when return on assets, return on equity come in play, and things like that. They would focus on the growth rate and gross margins and all that stuff. That's fundamentals, but they focus on the price movement of the stock price, and then they compare it to the fundamentals of real estate, which is completely wrong. So now that I talked about the dividend, just for the heck of it, let me take a look at the stock price. And like I said, at this point, I have absolutely no idea what the stock price of Darden Restaurants is. So let me look it up, because I have a point to make about that will help you understand why I am not a dividend investor versus a value investor focused on the business growing in value or growth or whatever. So Darden. Okay, so Darden stock price. It is $135 per share. And I must have bought it. It had to be around 40, because I bought it somewhere in the 2000s. I don't know. So from 40 to 135. And my dividends increased, because I used to be getting checks that were like 25 cents a quarter. I think it was a quarter. And now it's 88. So my dividends more than doubled. And of course, my stock tripled over this time period. And all I had to do was buy it, forget about the stock price, hold it, sit on my butt, and let the management and the economy do its thing. Now, so let's say that 0.88 is the dividend times 4. So I get about $3.50 a year in dividends, okay? Now, let's say if I owned 1,000 shares, that would generate $3,500 per year. Now, let's say if I owned 10,000 shares, I would be making $35,000 per year in dividend income. Now, a lot of people in the United States don't even make that much from a job, okay? And now, that would be a very nice passive income, correct? Now, what would I have to do? How much would I have to spend on those shares today to generate that $35,000? Well, I would have to buy 10,000 shares times 135 per share. I would have to spend $1.3 million to get that, okay? Now, I think that I can do much better with $1.5 million. And I have much better ways to generate passive income that doesn't require me to spend $1.3 million to generate $35,000 per year, okay? Because 3.5 divided by 3.5, which is the dividends per year, right? Divided by 135, that's about 2.5% of dividend yield. And yes, I get the growth. As you can see, I get the growth, but I get this kind of dividend. So I have to pay a lot to get that kind of dividend. Now, I'm not a dividend investor because, as I said, I have better ways of generating passive income that doesn't require that much capital. For example, I have my books, right? So I wrote 10 books, and my books now are generating about, $20,000 per year. Okay? So with the case of if I wanted to generate $20,000 per year in Darden Restaurant, I would have to put up $800,000 to buy the stock to generate $20,000. Do you think it cost me $800,000 to write my 10 books? Of course not. It cost me maybe, of course, it cost me time, but it cost me maybe 10,000 in total to write those books. And that's because I spent a lot of money on the first 2 books, which I didn't know how to do. So for me to generate $20,000 a year from books, I spent about $10,000 to do it. So I have a huge return on that capital, right? That's why I do this. That's why I generate passive income in other ways. And then I take my money and I invest it in stocks or businesses that don't necessarily pay dividends. And a lot of times I will invest money in businesses that just cut a dividend, because a lot of people hold stocks for dividends. So they cut a dividend, the stock goes down, I buy it, assuming that the business is strong enough, and then at some point in the future they will reinstate the dividend, and I will make much more money on the appreciation. So for example, I am involved in one company that is sensitive to the economy. The stock price was trading about $20 before this COVID thing started. And then, of course, because of sensitivity to the economy, the stock price went down to 3.5, so 3, let's call it $3. I bought it for around that level. And it went down because it's sensitive to the economy and they cut the dividend. But I know they have no debt. I know that when the economy recovers, they will reinstate the dividend. So now the stock is trading at almost $8. So I already more than almost tripled my money on it. And the dividend hasn't been reinstated yet, but the stock is up because the economy is recovering. We're getting out of COVID. And then there's an anticipation that the business will do well, and at some point they will reinstate the dividend. When they reinstate the dividend, I believe the stock will go anywhere between 15 to 20. And again, I bought it for 3. This will be a huge return for me. At that point of time, I will sell the stock, reinvest my money somewhere else, wait for another recession, and this is a go-to stock for a recession for me. Then when a recession comes, the business doesn't do well, the stock goes down like a rock, I buy it, and I do this over and over every time there's a recession. Another example of a good way of generating passive income that I have other than books is, some of you know, I have this product. It's called Perfect Pastry Pie Crust Mold. And all it is 3 rings like this that a guy sends me. See, these are 3 rings. It is cut with a laser out of a plastic sheet. So they cut like 3 of them, and you take that ring, you put it on a kitchen board, and then you put a pie dough in the middle, and you roll it out. And then as the pie dough expands, it expands to the edges of that plastic, and then you take it off and it becomes a perfect pie. So I have a guy that cuts it like this. He delivers like 200 of these. He cuts it, and it has a like a paper cover. So I take it with a knife, I peel the cover on both sides, and then I package it. The packaging is also delivered to me by a local printing house. They print it, and then they cut it in a circle, and then they also cut the back. So then I put the things in the middle, and then I scotch tape it all the way around, and then when I have 100 of these made, then I just ship it to Amazon, and Amazon ships it for me. So it's an example of a passive income that generates not a lot of money. That's why it's good for me, because other big companies are not interested in it, but I'm interested in it because it cost me about $500 to get this started, and I don't have to have a laser because someone else cuts it with a laser. So I use someone else's capital that the person invested in a laser, and I just pay them to cut it for me. And then also when it comes to the packaging, I also don't have a printer, right? I don't have a commercial printer. I pay someone else to cut it, so I'm using someone else's capital. So for me, I'm into it for $500, and every year I generate of pure profit of about $2,000. $2,000 a year in pure profit. So with the case of Darden, if I wanted to generate $2,000 of dividend income from Darden, it would cost me $80,000 to buy the stock. But instead, it cost me $500. So you can see how having your own little projects, having your own passive businesses, passive incomes that generate income is a much more efficient use of your capital to generate that, and then the capital that I have in stocks, the best way for me to generate more return on the capital is not investing in dividend-paying stocks, but investing in companies that are hugely undervalued, going through a transition, or they're small cap companies that are like where we have featured microcap explosions that are hugely undervalued or underfollowed, and that's how I allocate capital to the best of my abilities.